Good morning. It's Jeffrey Christian of CPM Group. It's 11:30 in the morning here in New York on Friday, the 29th of August. It is the last trading day of the month of August. That actually is a little bit relevant to some of the comments I'm going to make. I have a lot of things to cover here today. Talk about the precious metals markets, the economy, hedging long positions for producers and investors, and I'll touch on at the end the truth and reality about silver being called a critical metal by the USGS. It's not nearly as positive for silver demand and prices as some people would have you think. Now, speaking about some people would have you think, the comments have been made sometimes on these videos that I should focus on what's important to the market and the economy, and not so much on all of the nonsense that's spewed out about gold and silver and platinum on the internet. I agree with that, and I would love to live in a world where there's no nonsense. But there is nonsense, and a lot of people fall victim to it. So while I do want to focus mostly on the reality of what's going on in the global economy, the global political system, and what it means for gold, silver, platinum, and palladium in these videos, it does behoove us to spend some time knocking down some of the irrational things that people are saying about gold and silver and platinum and palladium. So I apologize if I seem to distract the audience from what's really important, but I think it's also important to know what's not important and what's not accurate and what is an outright lie. So I'm going to start here with silver prices because I'm coming back to gold a little bit later. Silver prices, we've moved to the December active contract. The September price earlier this morning, an hour ago when I was preparing this video, was $39.40. The now active December contract was $39.80. So we're seeing the silver price rise up and test that top of that market. We also saw gold and rise too. This is partly because of stronger economic conditions and a little bit of an increase in inflation indicators and a relatively sanguine unemployment jobless report on Thursday. So our expectation is that the price will move higher, but that we are in this consolidation period, which has lasted since the middle of July. We're testing 39, we're testing 40, and our expectation is that the price will go higher. And yes, sometimes we're wrong. Platinum prices, $1,354.80 an hour ago. That was up about $8 from where it was on Tuesday. You can see that the price, spiked higher in June and the first half of July, came back down. It's sort of testing that 1,300 support level, but it's also testing that 1375, 1350 resistance level. Our expectation is that when the price breaks out of this little consolidation range that it's been in for the last 6 weeks, that it will be to the downside with a target somewhere around $1,100 an ounce. And palladium also has spiked up in June and July, broke out of that range. The price was about $1,110 this morning for the now active December contract. Spot, if you will, September NYMEX palladium was $1,084. Our expectation has been that the blip up in platinum and palladium prices in June and the first half of July was a temporary spike based on speculative buying and investor inventory building, and that the prices would drift back down into their trading range. Palladium is now on a September basis trading below 1,100, which was sort of around the top that we've seen since late 2023, when the price had come down from 2,000 plus in 2020, 2021, and 2022. So palladium is moving back into that range. We expect it to continue to move lower and to trade in that range of 900, 950 on the bottom and 1050 to 1100 on the top. Do want to talk about gold, but before I talk about gold, I want to talk a little bit about our track record in calling intermediate buy and sell recommendations. Do we think the gold price is going to rise or fall over the next 2 or 3 years? We've kept this record since December of 1980. And you can see we've been pretty good at saying, no, this is a good time to sell gold, or at least not own gold, or hedge your gold position with a short position, short options or futures. And there are also times when we've been pretty good at calling it. For example, November of 2000, when we said that there's the golden renaissance that was going to happen, that more investors in more parts of the world would buy more gold for a longer period of time than ever before in history, and drive the price far beyond the previous record of $850 in January of 1980. And that, in fact, occurred. In late 2011, after the price had reached about $1,700, we issued a sell recommendation. We said we thought that you could see a cyclical decline in a secular bull market, that the price of gold could fall for 3 to 5 years and then start rising again as it had from 2000 to 2011. The price did fall. It dropped sharply in 2013. It fell to a low around 2016. We were a little bit eager. I mean, the price had the decline in the price had reached our target re-entry level of $1,200 in 2013. So we said, okay, this is where we thought the price would fall, to go ahead and buy. And we were a couple years premature. But after several years of consolidation, the price has been moving up again, similar to the practice that we saw from 2000 to 2011. And our expectation has been that you could see what a technician might call a measured move here, where the rise from 2000 to 2011, followed by a consolidation period, and then another similarly sized increase in prices. So we've actually had a pretty good track record calling the intermediate term. It's difficult. It takes a lot of science, takes a lot of art, and it takes a lot of honesty. You cannot believe something if you want to get your projections right. The only thing you can believe in is what you can know. It's a difficult thing, but we've got a pretty good track record over the last 45 years of doing that on an intermediate basis. On a shorter term basis, I normally don't include these price projection charts here. This is from our Precious Metals Advisory. Every month, we show what we think is a range and average that's likely over the next 3 months in the Precious Metals Advisory. And I put it in here because you can see that in our 7 August Precious Metals Advisory, the price was around $3,320 or so when we published that. And we said that we thought the price could rise as high as $3,500 in August, and then further $3,600 in the period September and October. And I put it in here because this morning, the gold price touched $3,500. So that's actually kind of good. The table here, we have a client that asked us, what's the track record by, how many times, with our short term, or what we call the ultra short term gold trade recommendations, which we sell along with silver, platinum, and palladium, and some other companies provide on their trading platforms. And Kitco publishes the gold trade recommendations, or at least a stripped down version of it. And a client earlier this year said, what's your, wins losses? We do have a hypothetical return, but he said, how many times are you right? How many times are you wrong? So we looked, and between January 2025, when that client started using us, 2023, between January of 2023, when that client started using us, and middle of February of this year, we had made 58 intermediate or ultra short-term trade recommendations to buy and to sell. And we were right 33 times, which was 57%, and we were wrong 25%, 25 times, which was about 43%. So we were better than half, and I think that actually is a very good thing. You can compare this to other people you listen to who throughout this period of time were telling you that the price of gold would be $10,000 by now, or by Christmas of last year, or by 4th of July 2023. We have a pretty good track record. Now, I bring that up because, and I want to focus here on the fact that, yes, we have this $3,000 base that we've put in for this month and the next 2 months. And then we have the price rising on the high end. And that $3,000 base is very important for what I'm going to talk about next with gold. And you can see that the gold price was never as high as $3,000 before March of this year. Now, CPM Group expects the price to continue to rise, but sometimes we're wrong. And even if we're right on the long run, that doesn't preclude the idea that the price could fall to $3,200 or $3,100 or $3,000, or it could go back all the way to where it was in January, $2,660. We don't think that's probable, but who are we to say, as Pope Francis once famously said. So bear that in mind when I start talking about protecting your gold investments, whether you're a producer or an investor. Here's the gold price. As I said, we touched $3,500 today. The December contract, when I was putting this together an hour ago, was $3,499.40, just below $3,500. And the September contract was $3,450. Right? So again, the price was never above $3,000 until March of this year. And it was never above $3,100 until March of this year. Our view is that the price is rising in the long run. A lot of other people have that view too. But our view is also that the price can spike down sharply, as it did when it went from $2,080 in the first quarter of 2022 to $1,680 in the fourth quarter of 2022. In like 9 months, it fell 20%. Things like that do happen in financial markets. Just ask anybody who has their pension fund in the S&P 500, right? So what we've found, we've provided hedging strategies to mining companies and other commercials since 1980-81. And we have an options strategy that we love that really works well over time. What we've seen over the last year is that the mining companies haven't been hedging, but investors have been. People that we said to them, we have clients who we said, hey, buy gold, and we haven't told them to take profits since 2013. We're telling them still stay long. And we could see higher prices. We are now seeing those higher prices. And what we've found over the last year is our clients agree with us. They say, on the one hand, we've sort of gotten to the record levels. CPM Group expects higher prices over the next 2 years from where we are today. But we are at these very high levels. And we had thought, well, if we see the gold price spike up to $3,500, we'll take profits. But I look at the state of the world, politically and economically and socially, and I look at the state of the United States and the devolution of the government and expectations now. people would never say this before this year, but they are now talking about the idea that the United States government could break its relationships with Japan, South Korea, and Europe and become part of an axis of countries with China and Russia. And some of the policies that they're pursuing seem to point in that direction. So people are very much concerned about the political, economic, and social fabric of their nations, of their communities, and of the world. So we're talking with our investment clients, and most of our clients are on the buy side of commodities, not the sell side. And they're saying, yeah, maybe I want to hang on to my physical gold and silver. And we're saying, yes, that makes sense. But you can protect yourself and maybe even profit if you see those spikes down. So yesterday, my partner, Carlos Sanchez, I asked him to, hey, what could be done in terms of a 12-month hedge? Again, if you go back 12 months ago from September of this year, the price was, well, let's see, it was probably around 2000. Excuse me while I look at this. Last year, the price was around $2,400 at this point. So it's up $1,000 from a year ago, 12 months ago. So what could you do to protect yourself over the next 12 months if you're worried about the price declining sharply? And he came up with two strategies. One was it gave you a floor price of $3,050. If the price of gold fell below $3,050, you could sell your gold at $3,050 using our strategy, and then buy it back at the lower price and take the profits. If the price went from $3,500 today toward $3,050 over the next 12 months, at some point over the next 12 months, this is not a long-term investment. This is saying, okay, I'm going to keep my long-term physical gold position, but I'm going to protect myself from downsides and maybe even profit from it. If the price moved down from $3,500 today to toward $3,050, there is value in this hedge that you could actually probably unwind the hedge profitably, even if the price didn't fall below $3,050. What's the price that you pay for this kind of protection, this insurance policy? Well, there's no upfront premium. You do have to put up a margin to cover yourself, yourself and prove to your counterpart that you're good for this. And you would give up $100 if the price rose above $3,800 an ounce. You would get the market all the way up to $3,700 an ounce. At between $3,700 and $3,800, you would get $3,700, unless you unwound this hedge before then. And over $3,800, you would get $3,000. You would get the market less $100. If those boys were right and the price goes to $10,000 in the next 2 weeks, you would get $9,900. You'd give up $100 of whatever the market price is. Carlos did another one with a floor of $3,100, where you would give up that $100 between $3,600 and $3,700. Not quite as attractive in our view, because as I said, our expectation is that the price of gold is going to rise, possibly touching $3,600 in the next 3 months, 2 months, but also rising even further. I mean, our expectation is that the price probably gets close to $4,000 next year. I know that's not 10,000, but it's pretty high compared to $2,663 at the beginning of this year. So that's what we're seeing savvy investors saying, okay, I want to stay long gold and silver, but let me buy some price protection in case the price does fall. Price protection that I'll give up a little bit of the upside if the price continues to rise. But if the price spikes down at some point, over the next year, I could actually take some profits out of that position and reduce my net acquisition price. Let's turn to the economy. 2 days ago, 3 days ago, 2 days ago, the U.S. Bureau of Economic Analysis came out with its second estimate of second quarter GDP. It was up 3.3%. The flash estimate a month ago was 3.0, so it's 3.3. They're showing more strength. If you disaggregate the U.S. economy and their way of calculating gross domestic product or economic output, you can see on the right that the biggest positive factor pushing GDP up from negative 0.5% in the first quarter, there was a contraction in the first quarter, to 3.3. The biggest factor pushing U.S. economic activity up was the decline in imports. There was an increase in consumer spending, which is the orange stuff all the way over on the left. I'm sorry, that's total GDP. Next to that is consumer spending, it was up like 1.9% or something like that. But the big factor causing GDP statistics to rise was a decline in imports. So very worrisome in terms of where we go from here in terms of overall economic activity. Now, people keep talking about the Fed and what are they going to do. And the Fed has two charters, right? Try to maximize employment. Here's your unemployment figures. And yes, it has ticked up over the last few months, 12 months, but it is pretty much at historic lows in terms of unemployment. And on the right-hand side, you see the initial claims, which basically have been pretty much flat for the last 12 months. So unemployment is low. Employment is relatively high. There are a lot of jobs going unfilled, which puts some pressure on employees to pay more, which factors into prices and inflation. So unemployment doesn't necessarily suggest the unemployment figures that came out yesterday do not suggest that interest rates need to be lowered in September. Today, we had the personal consumption data come out, and this first chart shows disposable personal income and spending and savings. And you can see that the orange part, which is the amount that consumers are spending, has outpaced disposable income increases in July. So roughly flat in June. In May, you had a decline in the income, and you had basically flat growth. You had no growth in consumer spending. People were very much worried about the state of the world in May for good reason. They were seeing a decline of about 5.5% in their disposable income in May relative to April. June, they were kind of neutral. And in July, they're spending more than they're earning. Or they're increasing their spending more than they're increasing their earnings. So again, doesn't necessarily bode well for an intellectual basis for lowering interest rates. And this is the personal consumption expenditures price index, which the Fed pays more attention to than the CPI, consumer price index. It rose in July, and it has been, again, relatively flat, above the Fed's target. The other charter that the Fed has is to try to get keep inflation under control. They define that as 2% or around 2%. That's their definition. That's their target. So if you look at what the Fed's charter says, which is maximize employment and keep inflation under control, you've got maximized employment. You've got inflation too high relative to where they'd like to see it, that does not bode well for an interest rate cut. That said, the financial markets right now, 87% of the people involved in the CME's FedWatch gambling, roulette wheel, 87% of the people expect the Fed to lower interest rates 25 basis points, 0.25%, at the September 17th meeting. So we'll see. The Fed says we're going to watch the data between now and then, and the data that's come out this week doesn't necessarily suggest that interest rates should be cut. I'm not saying that we don't expect them to cut interest rates. The market certainly expects them to cut interest rates. The administration is trying to destroy the Fed's credibility and the U.S. Treasury's credibility and the dollar and Treasury bill market. They're working really hard on that. But the Fed last week promised that they would try to ignore that political thuggery, bullying. Now, another factor that's come up is the USGS added silver to its critical minerals list. This will not boost U.S. government purchases anytime soon, if ever, or the price of silver. A lot of pundits on the internet are saying, "Oh, this is the thing that's going to destroy the silver market. It's going to crush the manipulation that suppressed silver prices from $10 all the way to $39, $40. They're clearly being manipulated and suppressed. But you have to understand what happened. First, the USGS has been chartered by law to every 3 years update its list of critical and strategic metals. The list then goes to other, and this, what they issued this week was a draft of their 2025. The last time they did this was 2022. The next time they do, so now it's 2025, it's 3 years. They come out with their draft list. It's open for public comment until late September. Then it goes through various other government offices and agencies, which are responsible for making decisions on financing any purchases or authorizing any disposals of materials that they didn't want, and buying anything that they might want. Just because the USGS said, well, maybe silver should be on this critical minerals list, doesn't mean that the government's about to buy silver or will buy silver or will stockpile silver. There's a big gulp there. Anyone who thinks that silver is a critical metal is wrong. And I'll debate them. We've done videos on this. You can search it. We've given speeches. We've written reports on it. Silver is not a critical metal. And if you don't believe me, listen to the Defense Department and the military. They do not want silver. They have not wanted silver in the national defense stockpile since the 1950s. They accepted some from the U.S. Treasury when the Treasury was getting out of using silver in circulating coins in the 1960s, and they immediately said they wanted to sell it. They were unable to sell it because there's a law that says that they can't buy and sell materials if it's going to have a material effect on the market price of those materials. And that's very important. The military, the National Defense Stockpile, may not buy metal if it's going to drive the price up. And they may not sell metal if it's going to drive the price down. The military ultimately found a way to dispose of the 137 million ounces that they had. In fact, I was involved in devising that. And that was the U.S. Silver Eagle coin, which for the first 16 years of its life used the strategic metal from the National Defense Stockpile. Once that was used up around 2020, 2021, they start buying metal in the market. The military does not see silver as a critical or strategic metal. USGS might say, hey, these thugs at the White House said we need to add silver in because they've got some buddies who have silver properties. But the military says, well, that's just fine. And we're going to work as diligently to buy silver in the future as we worked to sell it from 1967 until the Eagle came along in 1986 or so. Yeah. So anyone who thinks that silver is a critical metal, you're listening to demagogues and politicians and people who don't know about silver use. If you listen to the military, if you listen to the military contractors who build the torpedoes and missiles and electronic guidance systems that use silver, they will tell you, we don't think that silver is a critical or strategic metal. The other thing is that anyone who thinks that silver is being added to the critical metal list will somehow or other cause purchases soon or boost the prices are wrong. And if you don't believe me, look at the list, look at the prices of all the metals on that list for decades. And I'll show you the list in a second. But I will point out, nickel was added in 2022. Since then, nickel prices have fallen 46%. And the U.S. government has bought no nickel. Zinc was added in 2022, and the zinc price is off 39% since then, and the U.S. government has bought no zinc. So this is a list of the metals that are considered critical, minerals that are considered critical in the USGS list from 2022. In 2022, they added nickel and zinc. They took helium, potash, rhenium, strontium, and uranium off the list that they had as of 2018, 3 years prior. That's the link to the U.S. Congress report on it. It's a very thorough report that could help you understand this. But if you really want, you can go online and say, well, what's happened to any of these prices? I mean, aluminum's been on the list for a long, long time. Take a look at its price. Beryllium, bismuth, iridium. Iridium actually has risen. Indium has risen, not because the U.S. government was buying. Iridium and indium both rose because of private industrial demand increases. Same with hafnium. Picking out the metals that CPM Group does research on because we know those. Manganese, palladium. Yeah, it's gone from, 2022, it was about $2,000, $2,100, and now it's $1,100. Being on that list really helped that. The reality is that silver being added to the USGS's draft list will not cause the U.S. government to buy silver soon and will not cause the silver price to rise. Now, I hate to, ending where I started, I hate to spend time knocking down nonsense that really we shouldn't need to knock down. But the reality is we do, because it's there and people will make bad investment decisions based on bad information. CPM Group is paid to be right. We're paid to be honest. We work very hard to be honest. You can go to our website. You can buy our gold, silver, platinum yearbooks. You can subscribe to the Precious Metals Advisory and get those projections, not just for 3 months, but we also do 8 quarters on a rolling forward basis. And we do it for gold, silver, platinum, palladium, and rhodium. Every month we update that, along with a discussion as to why we think the price will do what it's going to do. You can subscribe to that on our website. You can get a lot of free reads, and you can send us an email at info@cpmgroup.com. In the meantime, be good to yourself. Be good to those around you. Have a good weekend. Try to do something good for the world. And we'll talk to you next week.